One of the big concerns for a retracement of a bear market or continuation of the bear market has been and remains a credit-related issue, something happening in the financial sector. And while we saw a brief moment of that risk, it bypassed very quickly and markets have gotten back into a very bullish tenor. And that's really kind of the thing that we're paying attention to. As we start to look at the markets, it's becoming a much more bullish picture. So here's what you need to know before the bell. The markets have now retraced 78.6% of the decline from the January peak of 2022. Now, why is that 78.6% retracement important? Well, when you take a look, and this is part of the Fibonacci retracement scale of markets, it's just kind of a mathematical calculation. But historically, what we find is that when markets make certain kind of retracements, so we have a decline from the peak to the trough, and as the markets begin to retrace, there are certain levels of resistances that potentially is where markets historically fell. So as we get into like the 38% retracement or 31.8% retracement, that's a typical level where markets fail. At the 50% retracement of the markets typically fail. So as they have a correction, that retracement back to that 50% level is typically about as far as it goes if the decline is going to continue. Once markets get above that 50% retracement, typically the markets move higher, and this is what we were writing about previously when this happened, and we kind of set our marks at 4,500 for the S&P at that point. Once you get above that 50% retracement level, now markets are back into a bullish trend. Now, importantly, once you cross over the 78.6% retracement, which is what we did a couple of days ago, there is historically really not any precedent I can find where markets don't retrace all the way back to all-time highs. Now, that does not mean that you're not going to get a correction somewhere along the way to that retracement back to all-time highs. And this is what I was talking about with Charles Payne yesterday, is that all-time highs are now becoming a much more visible picture for the markets by the end of this year, if not early part of 2024. Now, this also is a big designator. If you look back at the historical returns of markets between the time the markets peak and the time that markets set new highs, during real bear markets, the 1970s, 2001, 2, 3, 2008, when you take a look at real bear markets, it is generally several years before you get back to all-time highs. When you have a correction in the markets, which we have quite often, markets get back to all-time highs within the same year or within 18 months. So it's a very quick turnaround from the peak back to all-time highs. And so if the market does indeed set all-time highs here over the course of the next few months, heading into the first part of 2024, that will be a very good indicator that this correction that we had in 2022 was indeed just that, just a short-term correction, not actually a bear market, because that's the way the market cycles historically work. Now, importantly, again, as I said, before we get to these all-time highs, and this is something to keep a watch on right now, and it's also a very good reason to be thinking about maybe taking some profits and reducing some risk, is that the markets have gotten very ahead of themselves short term, where we still have, yes, a MACD buy signal right now, but it's at a very elevated level. And whenever you have these signals at very elevated levels, as we have now, typically there's not a lot of upside in the markets, and typically a correction does follow at some point. And this is particularly important when those very high level MACD signals occur with very overbought conditions of the markets. And right now we're pushing a more extreme relative strength index overbought condition in the market. So I would expect that within the next month to month and a half, as we get into August and September, that we will see a 3 to 5% correction, have the market retest probably the 50-day moving average and maybe the 100-day moving average. It could be that deep, and that will provide a much better entry point. But that does not negate, and you'll hear a lot, and when the market starts to correct, you're going to get a lot of the real bearish crowd coming out saying, see, it was a bull trap, here you go. It's not We're still going to be in a bull market, but a correction back to support is going to give you a much better entry point. We talked about this yesterday as well, to put equity risk into your portfolio. So I would be thinking about starting to maybe reduce some exposure here, rebalance some risk, take some profits if you've been chasing this market really over the course of this year, particularly in the tech sector, because we're likely to see a bit more rotation in the markets here over the next couple of months. But take a little bit of profit here, look to rebalance some risk, and use that correction when it occurs. And again, you have to be patient here, next 30, 45 days most likely, get this correction kind of in process once we get through earnings season, and that'll give you a better risk reward entry point for this potential year-end rally that will take the markets back towards all-time highs. So that's what you need to know before the bell this morning.